Okay, how do you establish business credit? Well, a business's credit is generally going to be separate from that of the individual. Sole proprietors and partners, oftentimes, the entity is disregarded. That is, the entity is treated as no different than the owners of the business. But when you have a separate business entity, a limited liability company or a form of corporation, then in that case you're going to likely want to build credit for the business, because once the business develops to a certain point, you'll no longer have to personally guarantee loans or provide capital yourself. That is, the entity itself will be able to borrow funds or establish a line of credit, etc. And in order to receive a competitive rate of interest on any lines of credit, etc., the business needs a credit profile. So just like an individual, the business has to build its credit profile to demonstrate that it's not a risk. So to the extent that the business can demonstrate to any lender that it is not a credit risk, then the interest rate on whatever line of credit or debt arrangement is going to be lower. So to start with, you look at your business entity and you'll file your business entity with the state, and you'll have it organized so it is separately from yourself. And we go through in other videos the governance requirements and the setup requirements for different types of entities. Next, you're going to want to open some form of business credit account. Now, individuals have traditionally used Experian, Equifax, TransUnion, these type of credit rating agencies, while businesses have traditionally used Dun & Bradstreet, or D&B. Okay, but now Equifax, Experian, and TransUnion also offer business services, so you can create a business profile with these entities as well. And oftentimes it's easier for third parties to check your credit via these entities. So it's probably a good idea to open up a credit file with all of them, Dun & Bradstreet, Equifax, Experian, and TransUnion, so you can get your credit profile going. When you set up your business entity, you're going to receive a tax identification number. Again, we go over that in a different video, but you paying your taxes and your tax return information provides the backdrop for what amount of risk a lender would assume is involved in extending credit to the individual. So getting your tax IDs and keeping up adequately with your business records will be important when you're seeking any extension of credit. You're going to establish a bank account. Okay, so that funds coming in and out of the bank account are easily reported. These transactions, again, can be reported to the credit rating agencies. You're going to get a business credit card. Okay, that is one of your first extensions of credit for the business, and you may have to sign a personal guarantee up front, or the owners, in plural, may have to sign a personal guarantee to get that line of credit, but that credit card. But as the business's credit grows, it may be possible to get that credit card or line of or other line of credit without signing a personal guarantee. Okay. Now, lastly, any form outside of a credit card of unsecured loan that the business can establish. Lenders will generally provide loans based on some form of security, right? The ability to post equipment or other collateral that could be repossessed or attached in the event that the business doesn't pay. Well, at some point, it may be an option to get an unsecured line of credit or a rotating line of credit. If the business establishes this, makes timely payments, never goes into default on anything, just like an individual, the business's credit score will rise. And as the credit score rises, the risk of default on any extension of credit goes down, and thereby makes credit more available and easier to obtain, and then the terms are easier to manage for the business, so ultimately more credit will be available. And that's how you build your credit profile as a business. Okay, just like with an individual, it's establishing accounts, trying to demonstrate that the business will and does make timely payments and covers its obligations, and establishing sufficient obligations to demonstrate that the business can manage and balance these debts or accounts. Okay.